Hey everyone, welcome back to the channel. I'm very happy to be with the main folks from Brompton once again, returning guests and champions, of course. Chris Cullen, Michelle Tiraborelli from Brompton. How's it going, guys?
Great.
Feeling like a champion, Adrian,
Yeah,
especially after
you.
that intro. Thank you.
I do my best. I do my best.
Hi, everybody.
So yeah, in today we're gonna talk about your new ETF that you just launched, which is pretty exciting because my community, the income-oriented community, we're all about income and split share funds are a pretty unique investment vehicle in Canada to do so, and you guys have launched. CLSA, that's the ticker symbol, listed on the Toronto Stock Exchange, right on the Canadian market. The Brompton Split Corp Class A share ETF. So this seems to be kind of like a Class A share version of SPLT. We know that you guys have launched SPLT ETF, which is kind of like an all-in-one split fund preferred shares. This
Yep.
is this seems to be the same thing, but on the
It's
more volatile and exciting Class A share. So tell me about it. How come you guys decided to launch this?
well, we really have had a hit with SPLT.
Hmm.
Many thanks to you and your viewers for considering SPLT for their investment portfolios. We've gotten a lot of uptake from advised channels as well. So investment advisors are loving SPLT as well. We've crossed $520 million in assets for that ETF. So it's our biggest ETF by far.
Wow.
And a lot of the feedback that we got came from investment advisors who have participated for many years in split share offerings. And they are generally, when they take down on an overnight offering or an IPO of a split corp, they take down equal numbers of preferred shares and Class A shares. So our SPLT product addressed quite a big part of their book, giving their clients a little bit of diversification and some better liquidity in an ETF format, that kind of thing. And we had inbounds requesting an ETF on Class A shares to bring kind of the same sort of idea to the Class A side, which is again diversification. Just
Yeah.
just just being able to address multiple sectors. Liquidity, much easier to trade in and out of a Class A share ETF, for example, than to trade individual Class A shares. And just bringing all the benefits that Class A shares do offer. Plus, we're trying to address a couple of things in addition to that. The idea for this Class A share ETF is not only to give you that exposure and to give you the potential upside that Class A's give you, but also to try to manage through the distributions. As we all know, the market goes up and down, Class A shares go up and down, and at some point, Class A shares they move to protect their NAV by suspending the distribution if the market's been under quite a lot of pressure. We're going to try to address some of that in this ETF. We're looking at a steady distribution, a consistently paid distribution through time. We're going to take, given where we're at right now with Class A shares, we're going to bank a little bit of the distribution that the portfolio is producing and save it for a rainy day, save it for times when markets
Ah,
get under
okay.
pressure,
So a
and
lot to
keep
unpack
that.
there. Yeah, a lot to unpack there. I think
Yeah.
you pretty much answered, I think, which is the number one burning questions that most people have regarding the
Oh,
Class A distributions. It's always the first hesitation towards the Class A shares in my or the first worry, the first concern, whatever you want to talk about, is that in case my audience doesn't know what we're talking about, we've talked about it many, many, many times. For the split share fund Class A shares, if the unit NAVs are under $15, that's the combination of the Class A share and the preferred share. The Class A share halts the distributions. It's kind of like a fail safe, right, to protect the
yeah.
NAV. So before we get into a little bit more deeper on that, the distribution policy, I just want to go back to the first ETF we talked about because it's possible some of my members or newer viewers don't know what we're talking about. So you had mentioned SPLT. This is the one that has over 500 million now in AUM. So this one is kind of like it kind of combines all the preferred shares of a split fund, which we won't get into now because we've talked about it, but this is more lower risk, lower volatility type of investment, whereas the Class A shares capture all the swings of the portfolio. So SPLT, just in case people are wondering what are we talking about at the beginning, we're referring to the SPLT ETF, but you guys have pretty much launched kind of a Class A version, CLSS. Sorry, I'm bad with stock tickers by nature. CLSA, CLSA. Wow. So
We designed the ticker so you can just call it Class A. You can call it Class A ETF if you like.
I didn't even realize it till you just said it. Wow, unbelievable. Yeah, I guess I need more coffee this morning. Sorry about that. But yeah, it's a great ticker symbol, great name for it now that I realize what it's for. So SPLT designed for people who like the preferred shares, a little bit lower risk, stable, 6% yield more or less. Who would you say, before we talk about the structure and the distribution policy, this ETF is designed for what kind of investor, if you want to compare it, I guess, for SPLT?
Yeah, I mean it's designed for investors who are looking for capital gains, in a leverage format, which are essentially what Class A shares offer to investors, who have a risk tolerance for that, but who are looking for something more than 6% over the long term, and for investors certainly who want all those other good things that I mentioned as well, the enhanced liquidity that an ETF brings, and active management that our portfolio management team is going to bring to the table that they will be, you'll never see 100% trading turnover in this ETF. The market just isn't built for very high volumes of trading, but our PMs will be looking for value and will be adjusting the portfolio holdings to try to benefit investors. And for investors who want a very attractive distribution, and one that's managed, as I mentioned, through the ups and downs that happen in the Class A market.
Okay, so let's check it. Let's check it out. See what it's about. Check out the structure, what's inside of it. So it kind of looks like SPLT to me because it has, like SPLT, it has a combination of all the providers, which there's a couple of big providers, including yourselves, Brompton, but also some split share funds from Quadravest and Middlefield. So it looks to me that it's kind of similar for this one as well. And as usual, Brompton, you guys always have like the nicest charts and documentation and things. If you go to fund documents, you'll see these documents that I'm showing you here. So this is the initial portfolio. So this is what actually the ETF holds. And it seems to me like it's just basically a combination of many of the Class A shares in Canada. So why did you guys decide to, like SPLT, combine all the providers and not just do Brompton ones, for example? Is there reasoning behind this?
Yeah, well, really, what we did with SPLT, in our view, and in a number of IAs that we talked to and industry participants, is we created a benchmark for the split corp preferred share section of the market. And when I say we created a benchmark, this product is the premier product in the split corp preferred share area, and it includes everyone. We're not excluding
Yeah.
preferred shares based on whether we manage it or not. What we're doing is we're looking for quality. We're looking for large and liquid issues that pay attractive distributions. And if you've got a split corp that matches that description, come on in. We're very happy to consider those preferreds for SPLT. So we're really trying to offer the same kind of breadth, the same kind of quality product in Class A as we have in split. And that's really the goal and the rationale for including all of the major Class A shares that are available in the market.
Yeah, I could clearly see really the big players at the top here. I think
Mhm.
DFN in terms of AUM, that's from Quadravest, is really high up there. FTN, LBS, that's from Brompton, FFN. These are the
Yep.
big liquid, like you just said, Class A shares, and you'll get some diversification not only with what's inside. We know that Financial 15, Life and Bank, North American Financial, very heavy, if not exclusively on the financials. But then you have things like Dividend, Growth Split, E-Split, a couple of other different things as well.
Mhm.
So would you say that this is kind of like market cap weighted? Because I don't see.
It's market cap
Okay,
weighted with a little bit of body English. Our PMs, if you like this list here, we haven't published a portfolio yet, but
right.
this list is roughly in order of weight in the
Okay.
market, and that's roughly in order of market cap weight. But there was some tweaks made just based on levels of premiums and discounts As you're aware, and as many of your viewers are aware, Adrian, the Class A shares and preferred shares of split corps are closed-end funds, and sometimes they will trade above their inherent value, their NAV. Sometimes they'll trade below.
Yes.
And as you can see, we're just trying to balance the discounts that are available, and there are considerable discounts available in the market to NAV with the size and the liquidity and our PM's view of the quality of management, that kind of thing. So it turns out to be roughly market cap, but there are tweaks around the edges as to how much we're holding to try to, excuse me, try to get
Yeah.
the best portfolio possible.
Yeah, in my opinion, I mean, and I've
Excuse me.
spoken about this many times, the discount, and the difference between the NAV and the market price is by far the most interesting thing of the Class A shares. And I've been, I do a report every week, and many split share funds, Class A shares, are trading at discounts. And I love that you guys added that column. You actually see some of them are in double-digit discounts. I know eSplit is very high up there. There's other ones as well, the life insurance companies as well. I literally just did a report a few days ago. So tell me about how you're picking and choosing the split share funds that are going into this, because in my opinion, you want to get the ones that are most trading at a discount, right? So are
Mhm.
you guys, I'm assuming this is where the active management comes in. Are you going to be skewed more towards the ones that have bigger discounts?
Well, we are going to be how do I put this? If market weight is the baseline,
Yeah.
we will have higher than market weight in the names that offer more attractive discounts.
Okay.
Plus all those other features as well. If we think that they're being well managed and they're in an attractive sector, and they've got better discounts, they will likely get higher than market weightings. But we will likely never, sell out half of this portfolio and focus on the other half. Just for the fact that we do want to keep maintaining liquidity and keep maintaining diversification among managers, among sectors, that kind of thing. So that would be more or less our active management
That
contribution here.
makes perfect sense to me, and it kind of sounds like it's kind of the same way you're managing SPLT as well. You're actively trying to find those discounts where possible, but you're not going to just completely go, 80% with one that has a really big discount. You're still kind of market cap weighted, but you're
Yep.
trying to, it's like a secondary thing you're going after, which is pretty good. I think it's, when I'm looking at Class A shares, I'm always looking at, okay, which ones are discounted? Do I like the portfolio? So you guys are like pretty much doing it automatically. You're doing this all automatically. So this is, I think, a big advantage of this ETF. You don't have to pick and choose your own Class A shares. You could just get the ETF. And
Hmm.
as you could see here, you see the average discount is 6.1%, which literally means, like you once famously said there, it's like buying a dollar for 94 cents. Kind of.
Yeah,
I guess that's
exactly.
6%.
Exactly.
I really love that. I keep saying that.
It's
So
very true. And
yeah,
there
so
are great benefits to not only do you get that dollar for less than less than the dollar's worth. I'm just going to pop up a slide if you don't mind, just that
sure.
Michelle and her team created here. But if you can see here, this is really one of the main benefits of buying at discounts. Typically, these things mean revert and they overshoot the mean reversion. So when you do buy at times when there's a 5% or greater discount, we've just lined up a number of our well-seasoned Class A shares. So those ones that have been outstanding for more than 10 years. And you can see, the least 1 year forward return over the last 15 years that one of these four major splits has experienced is Brompton Split Bank Corp. When there's a 5% or greater discount, the 1 year forward return from buying at that time has been over 18%. The other ones are much higher in the double digits. If you can get it at an even deeper discount, there's an even better reward that's available historically for buying these Class A splits at those times when the market is under pressure and when they're trading at discounts. So right now, given that the overall average for this portfolio is in the sixes in terms of a discount,
Yeah.
we view this as being a favorable time to begin putting some money or to continue putting some money into the split corp area.
Okay. And sorry, I'm just gonna stop the sharing. I just want to, just in case my audience doesn't know what discount means, I just want to show them real quick because I think it's
Yeah.
important. This is by far the most interesting part of closed-end funds. So
Hmm.
basically, I'll just do GDV and as an example. You clearly see that the closing market price. This is as of March 28th. You have the dates here, but it's, you know, you could, the market price is $10, 10.01 approximately. I don't know how much it is today. For the record, we're filming this on March 31st. But the NAV, the net asset value, what it's intrinsically worth, what it's actually worth per share is 11.15. So that means there's a big discount. And to calculate the discount, you do this. I'm talking to the audience here because I know you guys know how to do it. You do the stock price divided by the NAV price minus 1 times 100. And you'll get the discount. So GDV, for example, right now is about 10% discount to NAV. So you're literally buying a dollar for 90 cents. That's what it basically means. So I just wanted to make sure the audience knows about that. So you could go ahead and reshare if you want, Chris.
No, I think I've made my point is just that when discounts are available, buy them
Yeah.
because you're buying a cheap dollar, and buy them because historically speaking, returns have been great in the years following the market levels of discounts.
Yeah. Why do you think the discounts are, you know, I've always, you know, I've been following Class A share split funds for many years. Why do you think the discounts are still, it's like week after week after week, I'm doing this report and there's discount, they're still discounted. Why is it that investors are kind of not realizing yet, or is it fear? Is it, what do you guys think it is? I'm just curious on your opinion. Why do you think these discounts are being sustained for quite a while here?
I have some thoughts, but Michelle, did you want to take a crack at
You
that one?
you can go ahead and I'll add to whatever you had in mind to
Sure.
share.
Just, I mean, we did see a tremendous run up in stock prices
Yeah.
coming up into the 2024 year end. And it's a fact that the TSX or some of the US stocks that are held in split corps are very large, very liquid, and the Class A shares of those split corps have a lesser following. They don't trade as much, obviously, as the big banks or major Canadian corporations or U.S. corporations. And so, oftentimes, when there's a strong run up in shares, the NAV goes up, and the trading price of the Class A share doesn't quite keep up. And so, you get times when the S&P 500, the TSX is ripped, and it's not quite yet reflected in the Class A share trading price. So that would be one major idea. I mean, it's great that you and your followers on YouTube are very familiar with Class A's and are very comfortable trading them. But this is one of the few areas outside of quite a good sized group of investment advisors. But this is one of the few areas that the public certainly are informed on Class A shares and are comfortable trading them. And so if everybody subscribed to your channel, Adrian, I'm sure discounts would go away.
Well, let's hope
Which
that
would
doesn't
be
happen. Let's hope that doesn't happen because that's just less opportunity. But what you said was accurate. When the market rips, the NAVs of the Class A shares will rip very fast because they're leveraged. That's what class.
Mm.
But then maybe the market price doesn't catch up. I think maybe Michelle, you think that's accurate?
Yeah, that's something that we've talked about before, Adrian, I,
Yes.
I recall, and I think it was like late last year, and you brought the question, why are these trading at such discounts? And we talked about, how fast the NAVs moved higher over the course of last year, and we just didn't see the market price returns match those NAV returns that we're seeing in the individual split shares. So,
Yeah.
that's definitely led to there being discounts in the market, which, as we're talking about, has created a good entry point. But right now, I would add that we've seen a bit of a pullback this
Hmm.
year. So not only are you able to get in at cheaper prices, you're also getting a discount on top of that. So that's why we thought the timing of this ETF launch made a lot of sense.
Yeah, definitely. And before we get into the distribution policy, I just want to show the sector allocation of pretty much what you're investing in. So you see the, sorry, but I don't know why it keeps blacking out here. So you see by the issuer, so Quadrivest, Brompton, Middlefield, I would say the three biggest providers of split share funds in Canada. So a nice mix of manager, but you also have some diversification when it comes to sector. But I would say pretty heavy in the Canadian financials, which, my opinion, have held pretty strong. They're very tax efficient for Canadians. So maybe do you guys have anything to comment on the sector allocation before we get into probably the most burning question, distribution policy?
Well, I mean, Canadian financials is a real core sector in the split corp area.
Yeah,
Just the reason being that we have some very high quality, highly regulated financial institutions in Canada. They're very safe on a global scale. The banks and the life cos that we have on offer in Canada,
yeah,
versus many other jurisdictions, even versus the U.S. They have much larger financial institutions, but there tends to be less regulation and less to kind of keep them, on track to safeguarding investor capital. So we've got this great sector here that pays very high levels of dividends compared to a number of other areas, and it so happens that this is a perfect formula for the portfolio for split corps. We expect, even though currently the macro outlook that our PM team has is that wait and see on the tariffs and how will the economy go and that kind of thing. That is a pause time for banks and for maybe not so much for life cos because they're not so related to the underlying economy. But we do expect in the future to have continued strong performance and continued strong dividend growth in the financial sector in Canada. This sector will be a major part of Class A ETF going forward.
Okay, fair enough. And in terms of distribution policy, so we know that this is by far the number one concern I get when people talk about split share fund, Class A shares specifically. They could miss distributions. Some of them have never missed. I think GDV has never missed a distribution. The middle field ones have never missed distributions, but some of them can, especially if the unit NAVs are closer to 15. So I saw that the approximate yield of the portfolio of the ETF is about 16, but you guys have a target of 12, and you guys have basically declared the first distribution. Correct me if I'm wrong, at 10 cents here. So we're looking at a on a approximate $10 price, it's 12% yield. So it seems like you guys are holding back quite a bit of the distribution. Tell me why you decided that. What is the distribution policy?
I mean, we hear these comments quite often, Adrian, from yourself, and we get inbound calls in our investor relations line. There are times when the unit NAV does dip below $15 on a particular split corp share. We even get some investors calling in at that time saying, "Why is Brompton stealing my distribution? Why are you guys keeping it? Or what are you doing with it?" Like that kind of thing.
Yeah.
It's nothing as nefarious as that. How split corps work are, they're designed to be long-lasting investments. They're designed to provide benefits to investors for years and years to come in the future. If we get to a point where a $15 NAV is inherent, and say, for example, for split bank, $1.20 a year, 10 cents a month is payable. If the NAV on the Class A share gets below 5, and so the unit NAV gets below 15 as a result, if we keep paying that out for a couple of years and the markets continue to be under pressure, we're going to end up with no Class A share left at some point, because we just keep paying the $1.20, and who knows, So what we're trying to do is preserve the NAV at the time when the NAV comes under stress, and keep some NAV at work invested in the underlying holdings, and provide for the Class A share to spring back forcefully once markets turn and once the underlying share investments start to recover. That's one of the misconceptions we have about split corp distributions. I think is just that it's a bad thing. we're doing something weird with the distributions when the NAV goes under 15. It's really just that we're trying to preserve the structure, we're trying to keep the structure invested, and we're trying to protect the NAV on the Class A share when we do suspend distributions. Now, I hear you, and Michelle gets this all the time as well, that many investors are confused. They get upset when we cut off the distribution for those reasons. And so what we're trying to do is something a little different here. We're trying to pay out a sustainable and attractive distribution over the long term, which is paid out consistently in times when the underlying funds pay a distribution and in times when they do not. And so what we're doing is we're banking a few percentage points of the distributable income from the underlying portfolio, and we're putting it aside and saving it for a rainy day. We're keeping it invested in the Class A shares that the fund holds. And then if we do get into a situation where the markets come under pressure and Class A NAVs drop and suspensions begin to happen, and maybe we get 75% of the portfolio have a suspended distribution, we're going to continue to pay. We're not committing to a level of payment or anything like that, but we're going to pay an attractive level, and we're going to keep cash flowing into the pockets of investors on the Class A shares rather than suspend and follow the distributions on the portfolio. So right now, after what we saw in early March, there was some turbulence in the market and some downdraft in equities, and we're seeing 16-ish% yields on Class A shares. A lot of that's because the NAVs have started dropping and getting towards $5, and the distribution gets very, very high at those times until, as until it goes to zero. So we're trying to take a medium kind of position here. We're paying 12% to initially. That could go up if share prices strengthen and we think it's merited. And it could go down if share prices continue to be under pressure and the NAV continues to decrease. But we will pay a healthy distribution, and we will make it attractive for clients, and we will make a continuation of distributions for those investors that were concerned about that.
Yeah, I think that's a great idea. It definitely addresses the number one concern. You have the ETF wrapper now, so you kind of don't have to worry about that. And I believe it or not, I actually do see the comment of that all the time. When the distribution is suspended, they say like Brompton is stealing that 10 cents. And I just say, no, it's not. It's just the 10 cents is just staying within the NAV. Remember, everyone, I'm talking to my audience here, that 10 cents a month that comes out, or whatever the amount is, but typically it's 10 cents for all split funds. That comes from the NAV, right? And on X date, it goes down by 10 cents. But if you're not giving it, it just stays in there. So it's not like it's going to your pocket, right, Chris?
No, definitely not.
A ridiculous notion. But anyway, it's good that you've explained it and it makes complete sense. So we could expect pretty much, you're basically saying that no matter what, you could expect to be paid every month with this ETF. We can't guarantee that 10 cents, maybe it'll go up, maybe it'll go down. But because one, we banked a cushion, we're banking a cushion, and two, we're diversified within the sphere of Class A shares because some are much higher and have never missed or might never miss, and some maybe will miss and things like that. You're pretty, I can't say guaranteed, but you're pretty focused on delivering monthly distributions no matter what with this ETF wrapper.
That is our intention. Yeah,
okay.
Yeah, and we can't say guaranteed either, but
I know that's why I'll never say that. Right.
Yeah, that is our intention that we
That's the intention. Okay, and this is
continue.
actively managed. The management fee on this ETF is 60 basis points, right? 0.6. So you guys are managing, and obviously within the ETF also is going to have the other expenses of the other Class A shares, I guess, that are not Bromptons, right? You got to pay
That's
for
right.
those as well. So we'll see what the MER is a year from now. But in terms of management fee, it's 0.6, but you're getting, that nice active management where you don't have to pick and choose and blah, blah, blah. And to me, it's well worth it. 0.6 is not that much to me.
Yeah, that's all correct, AJ.
Okay, perfect. I think we covered everything. So what I would like to do now, if you guys don't mind, is just take a few questions from members that had a few questions. So, and I'm sure we covered, kind of the topics or answered it somehow. But first question from Dominic, with funds like DGS or LCS missing distributions over the years, how will this fund be impacted by the underlying NAV, GDV and LBS on their own are much better performers. Thanks. So I think this is regarding the, how will the ETF perform if some of those Class A shares start missing distributions, I think is the question.
Yeah. If you don't mind, Chris, I can jump
Go
in
for it.
here.
Yes, please.
So I guess just first off, maybe want to clear up a bit of a misconception that there may be around the performance of split shares that have had more missed distributions in the past. For example, using the examples in the question here, LCS has missed more distributions than, let's say, LBS or SBC, but over the last 10 years, it's actually performed better over that period of time. Same with DGS versus, if you look at 5 years versus GDV, it has performed better despite the fact that there have been distributions, more, no distributions missed for GDV, but there have been distributions that have been missed on DGS during that time. And I think so there's some misconception about that, coming back to the fact that there is a very good reason for having that $15 NAV rule, and how that can actually lead to very strong returns in the forward-looking period. So even when some of the underlying shares may have their distribution shut off, that it's actually a very good buying opportunity, we find, if you look at the historical data. So if you look at returns for some of these shares when they've had a distribution suspended, sometimes investors may sell the shares because they're only interested in receiving that monthly distribution.
Right.
However, remember these are leveraged investments. They provide leverage exposure to the underlying. So when that portfolio, the stocks in that portfolio recover, the Class A share value is going to recover in a more magnified way. So you have outsized return potential when the underlying market recovers. And so that's why you end up getting, very strong returns, even in those periods when the distribution is shut off. So this ETF and our, portfolio managers who will be actively managing it, will be taking advantage of opportunities like that as well.
I love that. And I'm looking at DGS here, which is basically some top dividend growth stocks in Canada, primarily. And you see that these are NAV returns, by the way, that we're looking at. Last 10 years, the average return is 13.8 per year. That's way higher than an ETF that holds the overall Canadian stock market, like an XIU, for example. And to your point, where these are leverage investments, you could actually see that in the bad years, you could see some very big downturns. But in the good years, for example, 2024, look at this annual, this return, 54%. That's pretty crazy. So yes, there's more volatility for sure because these are leverage investments, but they still invest in quality assets over time. And the ETF is basically, you're kind of lowering your volatility, in my opinion. Tell me what you think about this, guys. Instead of buying or picking like individual Class A shares, you buy the ETF, you're lowering your volatility because you're getting more diversification within the universe as well.
Yeah,
And
by definition, diversification amongst
yeah,
investments that are not perfectly correlated will provide lower volatility.
so it's a very interesting proposition. It's pretty good idea, I have to admit. And I know there's still a lot of confusion between split funds. I've done countless videos. I did a whole hour video with you, Michelle, trying to explain them. But I think it's starting to hit home. I think the community is, especially on the Facebook group, I see people, it's at a discount, I'm going to buy. And my saying is, the worst time to buy, the best time to buy them is when people are selling them and they're at a discount and the markets are down, because leverage means you're going down quicker. You're buying them really, really, really cheap, right? That's literally the best time to buy them.
Exactly.
And the worst time to sell them, right? If you're
What's the best time for me and you and Michelle to buy them, I think. Certainly.
Yeah.
And can I just mention, relating to this question, you're a very tactful person, Adrian. The question that I saw originally was that DGS and LCS had countless distribution suspensions. And that made me want to count the number of distribution suspensions. And
Oh,
I just noticed this question a few minutes before our video today. But DGS, for example, since inception has had 208 opportunities to pay a monthly distribution, and it has paid a distribution 175 times over those since 2008 was when that fund was starting to pay distributions, and that's 84%. And when I went to school a long, long time ago, that was an A.
right.
So I mean, it's true. If you want a distribution this month and it's not being paid, then you get a zero out of one, right? But if you look at the long run on DGS and on all of our Class A shares, more often than not, and certainly a lot more often than not in the case of DGS, you get that distribution every month.
Yeah, there are
But
some missed distributions. DGS, LBS has had some. SBC, I think just a couple in 2008,
mhm,
but some more than others, some none at all. But what the saying that I've been starting to say all the time now is the total returns is the ultimate truth,
Right.
mhm,
right? The total returns are net of fees. They include the distributions, missed or not, for the Class A share. So that's really, in my opinion, the gauge of how this fund is really performing.
mhm.
And a lot of these split fund Class A shares are basically all outperforming their benchmarks, and a lot of them have been around for 10 plus years now. So it doesn't not like we don't have the data, but I digress because we've talked about this for a long time, and you could see the total returns on your website. I just want to go to another question because this is a very interesting question. People don't understand how the distribution levels seem to always be 10 cents forever and not go up and down. So this question is pretty interesting. My question is, and this is from Mike Montreal. Do they ever plan on increasing the dividends on this new ETF? Because my complaint to Brompton is, for example, SBC, which is just Canadian banks. Basically what he's trying to say is, Canadian banks, insurance companies, they consistently raise their dividends every year, every quarter, but the distribution on the Class A share on SBC LBS stays at 10 cents, right?
Mhm.
So maybe you could explain why you guys don't increase the Class A distribution and what you expect. You expect the same thing for the ETF.
Yeah.
Okay.
Well, I can take the question about SBC and the distribution there. So, SBC is one of a number of split share funds that has, a 10-cent fixed distribution amount.
Yeah.
Some of the older splits that have been around for many years are are limited to that, same specific monthly distribution amount of 10 cents. But that's why, and SBC has been a very good performer over a long period of time. And yes, the dividends have grown in the underlying portfolio, and the Class A shares do benefit from that growth in dividends of the underlying portfolio. Because if I know you understand this, Adrian, and maybe for the benefit of the viewers, that any excess dividend income over and above what's needed to cover the preferred share of a split corp goes to the Class A share. So the Class A
Yeah.
share, NAV is benefiting from that growth in dividends and excess dividends. And so if you look back over the history of SBC, you'll see that there have been two share splits in recent years where, in effect, that was a way to increase the distribution rate for investors on those shares. So there was, a couple, in recent years where we've done that, where, there's a share split, investors were given more shares, but
Yeah.
the value was adjusted lower, which means that the distribution yield was adjusted higher. So that was one way of, kind of allowing Class A holders to kind of benefit from that strong total return performance of the NAV growth and dividends.
Yeah, I mean, the distributions, the portfolio, I'm talking more to the audience here. If it's a portfolio of the six Canadian banks and they keep raising their distributions, trust me, guys, the fund will benefit. Even if it doesn't give out more income, it's taking in more income. And like you said, Michelle, you got to remember that the preferred shares they're the priority. So they have the first crack at the dividends. This is why preferred shares, they don't miss dividends or anything like that. But it's still, like you said, if there's excess, it does benefit the Class A shares. And just talking about SBC, I just want to show this because like I always say, the proof is in the pudding, numbers don't lie, and total returns are the ultimate truth. SBC's been around for a long time. SBC is pretty much the six Canadian banks, and if we just take an ETF that only has the six Canadian banks like ZEB, with no leverage, no covered calls, nothing, and we do the total return comparison, this is 15 years of data here, almost 15 years, I should say. You see the dates at the top. You see the big performance discrepancy, and that's what leverage does, right? So this is why I personally love leverage products if they're invested in quality stocks you could hold for the long term. So this is a perfect example. Your 10K investment would have went to 40 if you just hold the six banks equal weight in a regular ETF, or 52,000 with SBC. So the proof is in the pudding. So I always tell people, look at the total returns. They're always the ultimate truth. And I know I'm talking a lot now. But last question is around the 12% yield. Some people might be disappointed by that, although we discussed the reason why it's 12%. It's not
Yeah.
like if the fund right now is making approximately 16% yield, you're giving out 12, you're not keeping 4% for your pocket. It's staying within the fund. So question is why 12%? It's not that attractive considering the yields on the Class A shares. You kind of answered it already, Chris. We kind of went
Yeah.
through it, but what would you say to that member?
Well, we looked at the last decade of dividend yields in the Class A share market, just on an aggregate basis. And yeah, there's times when, as we mentioned, that the dividend yields get compressed when NAVs are below $5 on the Class A shares. There's
Yeah.
times when they're 20%. Usually that's just before they go to zero. Right. So they go up, they go down, and assessing the last decade, the average Class A yield was approximately 13% over that time. That includes any
Ah,
times that distributions were cut off, any times that distributions were lower because Class A NAVs were strong and the dividend remained the same. So, they can drop for that reason, or assuming times right now when they're averaging around 16% on a market basis. So 13% minus 60 bips management fee and some trading expenses. We want to call it 1%. We came up with a 12% handle on that, and we figured that was a pretty good way to go out there. We're going out with more or less the average yield minus a small amount for expenses for the ETF. And we're going to try to manage it in that kind of way to try to average things out for investors over the long term.
that's a pretty important stat. So basically what you're saying, the last decade, the average yield, including the missed distributions factored in, is about 13. Right now it's 16, maybe,
Roughly.
and they're, none of them are missing as far as I know, but they could start if the markets keep going down.
Hmm.
So you kind of have a little cushion for the management fee and the trading it. So I think it's more than fair. I think, how funny is it that nowadays we, especially in my community, I kind of laugh at it a little bit. That 12% is considered low,
Yeah.
right? It's kind of funny to see that, but that's just the
Well, it's
world
no.
we're living in now with all these new great products with leverage and things like that, cover calls, et cetera, et cetera, et cetera. And by the way, and I didn't even ask, but Class A shares, you guys do. I know you can't speak for the other ones, but I'm pretty sure they do as well. You are doing some covered call writing within those Class A shares. There's leverage, capital gains leverage because all the portfolio movement. So let's say SBC, the six banks go up, the Class A shares will benefit even more because it's leverage. But you guys are doing covered calls on systematically on the Class A shares as well, right?
I wouldn't say systematically, Adrian. We give our PMs extra tools to manage the portfolio through allowing cover call writing in these portfolios. Let's say that it's for Brompton, it's an active cover call program.
Yeah,
That means we give our PMs the discretion to add value where they see fit through writing calls. Also, if they see fit to add value through not writing calls,
yeah,
that's available to them as well. So they can write anywhere from zero to, I can't remember, Michelle's at 75% of the portfolio if they really felt like they would.
Yeah, typically not more than
Oh,
35%.
not more than
That
35.
would be like the very high end, but often it's much lower than that. Yeah.
Yeah.
You're
Okay.
talking about
So,
Um,
coverage 35. Yeah, which is
yes, that's right.
pretty
That's right.
low end standard, I would say in
Hmm.
Canada. It's typically 30, 33, max 50. So this is
Yeah.
max 35. And would you say
mm,
the guys are doing typically when they do decide that cover calls could be a good situation? And I know we discussed this in detail, Michelle, of when they would decide to write, when not to. But would you
Hmm.
say they typically do out of the money calls and not at the money, right? They're definitely less aggressive with the call writing.
Yeah, it's typically out of the money calls. And like you said, Adrian, it is a more active approach. So there's times when they'll be writing on a bigger percentage of the
Yeah,
portfolio. And those tend to be times when, there's more volatility in the market and the premiums that can be earned from writing calls are more attractive. So it makes more sense to write calls during those times, and the team will write on a higher percentage of the portfolio. But then times when volatilities are lower, and which typically coincides with rising equity markets, you want to be writing on less of the portfolio to capture more of the upside potential.
yeah,
So you're not limiting your upside as much.
yeah. And I did discuss this with Laura as well
Hmm.
on the channel, and she said the exact same thing. I think my general view of Brompton's view of covered calls is that they use it as a tool to generate additional income, but it's not about the cover calls. Laura said they strongly believe in the names and the stocks and the growth of the portfolio more than just writing calls willy-nilly. I would say I would classify them more as growth slash total return products with income secondary. And I
mm.
think that you mentioned that as well in a previous Q&A. Would you say that's accurate?
Yeah, that sounds right. I mean, there's definitely focused on total return, with that return, that leverage return that you get over time, which you're getting enhanced performance, and then having some of those returns paid out over time through the form of cash distributions is really what the Class A shares are all about.
Yeah. Yeah. So you guys have been great. Spent a lot of time as usual. You're very generous with your time. I have to say, ETFs are. Oh, hold on a second here. Recording. Yeah, I mean, it's incredible how the ETF space has evolved. It's like now you basically made Class A split fund investing easy, more straightforward, and you've eliminated most of the concerns that people have, kind of like you just did with SPLT on with the preferred share. So I think, whether you invest in both of those, whether you choose one or the other, depends on your investing goals. But I think this ETF was a great idea, guys, great launch, and hopefully it's successful, and we'll be watching it very, very closely. So thanks again for your time, guys. Really appreciate it.
Thank,
Great. Thanks
thank
so
you for
much.
the, yeah, thank you for the kind words, Adrian. You know that how important split corps are to Brompton. So it's great to hear you say that, and we
Yeah,
hope
and
we hope that your followers get a lot of value out of these split corp offerings.
they are loved in the community, sometimes hated, but we're trying to shift it more towards the love. But it's typically because they don't really understand them
Yes.
yet, and it's typically because of the distribution suspension, which you guys pretty much have solved with this new product, to be honest. So I think that this ETF will be a hit. I think personally, it's a great way to invest in the Canadian financials, right? Because it's very Canadian financials heavy with leverage. These are, and as we saw with the results, you put leverage on something that you could hold that's quality and you could hold for a long period of time. You're only going to get, probably better returns over the long term, which is great. So I wish you guys success with this new product. Definitely very interesting. I'm sure the community will love it and hope to have you back again soon.
Fantastic.
Great. Thank
Thank you.
you.
Take care.